Hi guys, welcome back to another video. In this video, I'll go through a few REITs' recent results and sharing on the risk and reward that can be observed based on the analysis. Now let's dive right into the first REIT. The first REIT will be Mapletree Industrial Trust. For those who are new to MIT, it's quite similar to Ascendas Reit, where they are a REIT that manages multiple classes of properties. Now if we look at their key highlights, higher net profit income and distributable income to shareholders due to new asset contribution from the Hyde Park and Osaka data center. However, the DPU still dropped due to enlarged share units, and it is quite common for REITs when they issue more shares for cash. Similar to Mapletree Logistics Trust, Mapletree Industrial Trust has been actively issuing fixed rate notes for money. This is smart as this would limit the increase in their cost of debt. In this high interest rate environment at 3.751%, I think it's still quite reasonable. If we look at their quarter-over-quarter results, seems pretty even with revenue growing, but the property expenses and borrowing costs also continue to rise. MIT also registered a drop in the property valuation, as you can see from the drop in the 210 million registered. Now this is important for REITs because for big REITs like MIT, it does not affect their overall assets that much. But for small REITs, the drop in valuation will greatly affect the overall asset amount and may artificially increase their leverage ratio. Overall, I will say that it's a good win for MIT. In my previous video, my concern is that once the extra compensation distribution ends, I was expecting their DPU to come in lower. But thanks to the good performance from the new assets of Osaka DC and the Kallang Way high-tech building, MIT was able to maintain their distribution. Next, let's look at their debts. For MIT, it's quite decent with their leverage ratio at 38.7%. The concern will be in the financial year of 25-26, where the debts need to be refinanced or paid. Hopefully when they renew, the interest rate might be lower. With the constant issue of bonds and perpetual security, it's important to focus on their adjusted interest coverage ratio. At the ICR of 4.3 times, it's still at a healthy level way above the required amount of 2.0 times. Next, for the rental reversion, it was good across the board for this quarter. If you can see, both the renewal of the current tenants and the new tenants came in higher except for the high-tech building. Osaka DC continues to contribute quickly to MIT, which is exciting. With the phase 3 and 4 underway, it's expected to continue to contribute to MIT's overall income. However, one disappointing thing is that they have stopped reporting the progress of the Kallang Way's high-tech occupancy. But I guess, as long as it continues to get more tenants to be the positive force on the upside for MIT dividend, then it is good. With the current share price, you can expect a dividend yield of at 6.08% with quarterly dividend. Next, let's talk about another REIT like Mapletree Industrial Trust, which is Ascendas Reit. Similar to MIT, it's one of the largest REIT listed in Singapore with a lot of different classes of properties. This makes it more stable and investors always consider it as a safer dividend REIT play. Looking at the key highlights, one flexibility that big REITs have is that they can easily divest or improve their properties due to the large amount of properties that they have. Therefore, modification to one property out of 100 will have less impact on their total income. The annoying thing about Ascendas' Q1 result is that they do not issue revenues and income information. So we will have to wait until the first half for the full results. For Ascendas Reit's debts, unlike MIT, the cost of debt actually increased by 0.3% to 3.8%. And we can see this is way higher than MIT's cost of debt of 3.1%. With the increase in the cost of debt, the adjusted interest coverage ratio will naturally drop. Therefore, in this high interest rate environment, even for REITs themselves, sometimes based on how the management works, the cost of debt will vary. That's why for MIT and Ascendas Reit, even though they have the same classes of properties, the cost of debt is different because their properties are in different countries. Different countries will have different interest rate, and therefore the debt of course will also be different. With the debt maturity profile, they have a well spread out debt. However, this may also hit back at them when they have to refinance the debts, especially in the financial year of 24 to 26. The unfortunate thing for them is that the portfolio occupancy had dropped throughout different countries. But the positive note is that for Q1 rental reversions, especially for the logistic rental reversions, it continues to run, which is good and it shows that there's still very strong demands for logistics. This might be good for MLT and Fraser Logistics and Commercial Trust. Ascendas Reit have been known for doing private or public placement, which will dilute shareholders. Therefore, if you notice, the dividends never really increase even though it has continued to grow. With the current share price, it's expected with the dividend at 5.61% with semi-dividends. Next, let's talk about Mapletree Logistics Trust. MLT is a logistic company which is well attractive since logistic properties are usually in high demand regardless of which country. They also have properties in many different countries which might reduce the risk of foreign currency concentration in one country. One example is Fraser LLC, where most of their properties is in Australia. Therefore, for the past few years, their dividend continues to drop as long as the Australian dollars keep weakening against Singapore dollar. For MLT, it's more stable on top of the good spread of their top tenant contributions, with the highest tenant contributing only 4% of the total revenue speaks about the diversity that Mapletree Logistics Trust has. During this past year, MLT has been very active in acquiring and divesting properties, with over 12 Grade A logistic buildings being purchased while 9 properties were being divested at premium valuations. So even though the overall assets have increased, their DPU still decreases. So if you look at the reason why, it's surprising because of the revenue drop due to lower contribution from China and SG properties. The additional pointer is due to the weaker currencies. Property expenses and borrowing costs also increased as expected. This is the main problem for all REITs. As long as interest rate stays at the high level, all the REITs will start feeling more of the impact of this high interest rate, therefore causing their DPU to continue to drop. In this case for MLT, DPU surprisingly came in at 1.9% lower as the new assets are unable to outweigh the decrease, unlike MIT. Debts is higher year over year due to active acquisition at 38.9%, with the cost of debt surprisingly at a lower level of 2.7%. This is way lower than MIT and Ascendas Reit. However, if you see the adjusted interest coverage ratio, there's a huge gap difference in the interest coverage ratio from 3.7 times to 3.1 times. This shows the larger amount of perpetual securities that MLT have, which is another issue for a lot of REITs. If you see their recent issues, the bond or notes were issued at 3.81%, which is way higher than the current cost of debt reported here at 2.7%. That's why for investors, it's important to take note on how much perpetual securities that a REIT has issued. This is because the reported leverage and the interest coverage ratio do not account for the amount required to be paid from the perpetual securities that they list out. Even though I like MLT, I might have to be critical when it comes to this kind of financing. My concern will be that in this high interest rate environment, I do not think that they can keep it at a low cost of debt of 2.7%. So we have to see if the new assets purchased by MLT will somehow be able to contribute more income to prevent the DPU from continuing to drop. Unlike MIT, which had nicely finished their asset enhancement, MLT asset enhancement will only finish by first half of 2025 and 2028. So the impact to increase their income without acquisition is low. But this does not stop MLT from being a solid REIT. At the current share price, the expected dividend yield is at 6.63% with quarterly dividend. But if you are more conservative, you can assume more drop in the dividend and determine what share price you would want to purchase it at. Next, let's talk about AA REIT. AA REIT is smaller compared to the previous three REIT that I just analysed on. They are quite similar to Mapletree Industrial Trust with the type of properties from logistic to business parks, industrials, and high-tech buildings. The only class they do not have is data centers. What is attractive about them is that they have properties majority in Singapore and in the logistics section. This makes them a favorite long-term for investors. However, later I'll explain why they are priced lower due to higher risks involved. Now let's look at their performances. If you see this slide, since 2022, everything is on the rise, with the net property income and rental reversion steadily going up. So, you will expect the dividends to come in higher, right? No, it's lower year over year even though the income is up. Why? It's because the one common main issue among the REITs, and that is the increase in the number of units issued. Back in June 2023, there was a preferential offering offered at $1.189 per share for shareholders to purchase. REITs do this is to raise cash, but it in return dilutes the current shareholders. That is why the negative thing about REITs is that if you are a shareholder, usually it's required to join the preferential offering in order to buy those shares at a discount. If you do not join, usually there's a risk that your remaining holdings will suffer a drop in the dividend, which we can see here in this case. So with the preferential offering, the amount of total share units that they have increased by 11.8%, therefore outweighing the increase in the income. So if you are a shareholder that did not participate in the preferential offering, you will be getting lower dividends due to the share dilutions. Next, let's look at their debts. The leverage ratio as shown here is fantastic at 32.6%. That is way below the limit of 50%. Because of the preferential offering, they use it to pay down most of their debts, bringing down 36.1% to 32.6%. However, the cost of debt has went up to 4.1%, which is expected due to high interest rate. But the interest coverage ratio is one concern, as you can see that the adjusted interest coverage ratio is very low at 2.4 times. Even though their interest coverage ratio is at 4.1 times, their adjusted interest coverage ratio of 2.4 times is due to the high amount of perpetual securities that they have issued. As an investor, it's important to take note that these perpetual securities are not counted in their leverage ratio in the balance sheet. So with the inclusion, it might be way higher than 32.6%. So this is one of the main reasons why this REIT is priced cheaper with higher dividend yields compared to the previous three REITs that I just analysed about. On the bright side, rental reversions are still coming in strong for logistics sector at 51.2% in Q4 alone. For the logistics, there is still probability of higher rental reversions as the rents that they are currently charging is at $1.46, while the market average rental is at 1.4 cents to $1.80. That's why for logistic leases expiring, it will benefit AA REIT with higher new rentals coming in. Another riskier part of AA REIT is that they have a more concentrated top 10 tenant base. Woolworth is at 13.4% of their total income, while Optus is at 10.3%, and their top 10 tenants contribute a total of 51.3% of their total income. It is different from the previous 3 REITs, where they have a tenant income contribution that are not this concentrated. So why is this risky? It's because if any of the tenant collapses, they will lose this amount of income temporarily, and this would definitely temporarily drop the dividends given to shareholders. Overall, there are good and bad about AA REIT. That's why at the current share price, the expected dividend yield is at around 7.52% with quarterly dividend. I hope this video, through analyzing the recent results of these 4 REITs, can help you in terms of learning and making your own investment. Thank you so much for watching. You can watch my other video, which is the guides for REITs if you are still new to REITs, or if you are interested in investing in banks as dividends, you can watch this video. Thank you, and I'll see you in the next video.